Hey, it's the Fintech Newscast. My name's John, and with me, as always, is Steve. Welcome to the show.
Great to be here, John. How's it going?
Good, good. And we're really lucky this week to have someone that can clear up a few things on the latest on on the future of finance, really. Michael Egorov, the founder of Curve Finance. Welcome.
And nice to be on the show.
Yes, yes, I feel the energy, Michael. I feel it. Yeah. All right. Well, maybe this will get you excited. Our news story for this week is an announcement from some major players in fintech and finance: Stripe, Visa, Mastercard, and interesting, along with some kind of e-commerce players like Shopify and Mercado getting together to build a getting together for a consortium to build a blockchain based on stable coins for cross-border payments, and I would think to support commerce. What do you think, Steve? Does this look like vaporware, or do you think this is just the announcement? There's no software. There's nothing agreed on yet, so there's still a ways away.
Well,
But do you like to see this kind of thing, or?
I do. It's interesting because we have also the major card networks, right? You have Visa and Mastercard. You have Stripe as well, and as you mentioned, you have Shopify. So you basically have all the players that you need in the space. It's interesting. Just to take a step back here, the way that cross border payments work is that traditionally they rely on something called the corresponding banking system, and that is basically where Bank A will tell Bank B, we have this much to transfer, etc. Please pay them at the other end, and it's a very expensive, very complicated, very slow process. I think that this has always been, for me at least, one of the sort of the pinnacle use case for stablecoins is how do we facilitate faster, cheaper cross border payments. So if they can pull this off, and I think we have the right players in the space, this could signify a massive shift in how we move money around the world.
yeah, absolutely. Um, and it was about crypto, not necessarily stable coins, but with stable coins, it's better.
Exactly. Yeah,
Yeah.
yeah. But I actually, Michael, I have a question for you. You're the expert. You work at Curve in this space. Why would crypto be a better use case than a stablecoin for this, or how would you design this to make this be a successful product to enable
Oh,
cross
I
border
mean,
payments?
stable coins are probably more actually suitable for this. But I mean, I actually touched personally this for my personal
Hmm.
uses, this use case in general. Back in, I think, end of 2013, I discovered Bitcoin for myself, right? And in 2014, I had, I did have to do some small cross-border payments, essentially. So, well, first I tried was normal banking, right? And my transaction got reverted several times, and I got charged for that because I don't
Wow.
know, some typo in, like, so it's like, mm, I had to suddenly had to do something in the name, like, I don't know, uh, essentially specify second name or something, like whatever, something in the information was not right, so it got reverted, right? Despite all the accounts were correct and so on, and it was like going through many days, and it was ridiculous. So I thought, okay, I don't like that. I need something better. So I tried to do via PayPal, and
Mm.
it kind of worked, but then PayPal blocked this without actual explanations. So I couldn't send anymore, and I thought, okay, well, all right. So I have this Bitcoin thing, and I see that there are different sorts of different Bitcoin markets. So I can buy Bitcoin here, sell Bitcoin there. I can do it myself. Looks like I see how to do it. So why don't I do it? And I don't, the person on the other side doesn't have to know it's Bitcoin. The money just appears on their bank account. Why don't I do that? So I tried, and it worked. And then I tried again, and it worked again. and yeah, it just works. Well, later on, stable coins kind of replaced Bitcoin and that, but really, this all the necessary components appeared in different countries. Like in Europe, for example, we have digital euros, which can be redeemed to bank accounts. In Switzerland, we do have some digital Swiss franc, which can be sent one-to-one to bank account. And I can even pay bills with that. And actually, I'm doing that. And I'm actually swapping US dollar stable coins to these stable coins on Curve and sending. And of course, you could say, why don't you do it in a bank? And well, I mean, my funds originate from on chain these days, so I would
Anyway, huh?
have to I would have to send to bank and then initiate a transfer, and then it's when it's not the same, well, not like, let's say, between Switzerland and Europe, I think you cannot use SEPA instant, so it's like not quite instant, and you need to do some confirmations and whatever, and I also need to put it in the bank, and I need to interact with humans for that, and I don't
Well,
know
it
why.
looks like the incumbents are feeling the heat
Yeah,
of this kind of
yeah, true,
faster, cheaper. So you see announcements like this where Visa and MasterCard are trying to
true.
get off their existing rails, which are
Yeah,
very expensive.
there are
Merchants are
actually,
paying 3% of
yeah,
their revenue. If you're selling 200,000, you're giving away up to
yeah.
$6,000.
But
That's a huge
honestly,
expense.
yeah, but
It's
honestly,
huge.
this expense is not for transfers. This is for supporting all sorts of chargebacks and whatever. So this is like PayPal, for example. Also,
Executive millions of dollars in bonuses. I'm kidding.
well,
So yeah,
that also,
there's a
that
lot of
also,
fat in there too.
yeah.
Yeah. And
But
JP Morgan and other ones are checking out stable coins and
right,
looking into
right.
this kind of thing. So we see this kind of announcement. I think that's kind of like a vindication that they
Mm,
know that there's something wrong, and
mm, yeah.
they're
The
trying to
question
keep
is,
their moat,
yeah,
but still get the marketing
right.
and system benefits.
The question is,
Exactly.
what exactly is wrong? And I think answering this question would probably determine whether this will be a success or not, whether it's a worthy effort or not, right? So what is exactly wrong here? And like in
I think
principle,
you're going to tell us, Michael.
yeah, like in principle, if you think about consortium methods of payment of value transfer across the border, there is SWIFT, which is a consortium thing also, and it's just sending electronic messages, right? And
Yeah.
why are like messages are fast, right? They're electronic. It's like they're not sent over the ocean on turtles. So why exactly is it so slow, and why is it so expensive? And I think there are two things. One thing is compliance. So they have to screen transactions, and if it's cars, they need to support chargebacks. But even if it's not cars, they still need to screen transactions. That costs. But also, there are all sorts of middlemen everywhere, right? And they have this effort, which, how they call it, disintermediation. Yeah, that's how they call it.
Yeah.
So
Yeah.
removing
You sound very grad
intermediaries.
school.
Yeah, it was like a topic for a long time, right? Essentially, crypto is, and DeFi is what is removing intermediaries, right? Like all these costs are in intermediaries and compliance, right? So you need to have less intermediaries and or less compliance, right? So can they do it if they do it differently?
Question. My impression is that, again, all these players, Visa, Mastercard, Stripe, etc., even Adyen, I think they, because they're regulated, they place a tremendous importance on compliance, right? KYC and all that, and AML,
Yep,
and
this
nobody
component
wants to
doesn't
get
go
caught.
away.
right? It'll still be there. Nobody wants to get caught funding, Hezbollah or Hamas or something. So I presume that this will have a layer of compliance that you don't see from, say, an independent company doing this. I think this also de-risks the entire enterprise because you have basically, again, a consortium of well-known established companies doing this. So sort of that
Right.
layer of, again, compliance and KYC is on there in a way that you wouldn't see from a different player. So if any,
Okay.
as far as I've seen, like in terms of the cross-border payments, this is, I think this is one that's more likely to be poised to succeed. But I would love
Right.
to actually understand from your perspective, Michael, how what you're doing at Curve aligns with the strategy or how you're playing in these stablecoin space.
Right. Well, I mean, how it works in the wild, in where Curve sits in the middle, essentially. You have a bunch of stable coins, which are redeemable in different places. They have their own compliance mechanisms, and these compliance mechanisms play out at mint or redeem time. For example, you want to go from your bank to crypto in the US. What do? You probably deposit funds to Coinbase and convert those funds one-to-one to USDC, and you send USDC to the chain. And well, yeah, you're on chain now. So you pass compliance, of course, because you did your onboarding to Coinbase and you're on chain. Now you want to get this money, I don't know, you want to get this money out in Turkey, right? For example, because I don't know, you want to buy something in Turkey. Yeah, they do accept USDT, by the way. So you change your USDC to USDT on chain, and yeah, send it to the recipient in Turkey, and they use it like exchange on some OTC desk, and maybe they do some sort of compliance or like whatever they do, but it's different from the US, so it's kind of their different sort of measure, and the exchange from one flavor to another happens on chain, right? So you've got your cross-border payment, or let's say, well, I've got my USDC and I want to pay for something in Europe. So you can buy, I don't know, some Euro stablecoin like Euro E, and it's redeemable to IBAN, and you send it to IBAN, and like it just redeems there, and you got your cross border in the same way. You got a mint of USDC and redemption like when you spent it, and you did get some compliance here and there, and maybe they also screen their source of funds on chain because everything is transparent, so they put it through those tools. They check that the address didn't interact with any dirty funds, and like it's all transparent, and that happens automatically and quickly. So that's how it happens on chain, right? I mean, some people don't like these compliance checks on chain because like it's sort of everything is too transparent. Everyone can see if, but that's how we live on chain anyway, unfortunately. Or fortunately, I don't know. But that's how it is. But in exchange, it looks like everything is pretty fast, but the processes are totally different. You have compliance happening differently, and you don't have intermediaries doing exchange between different flavors of stablecoins because it's all decentralized. So you have only intermediaries that's facilitating touching the real world for you. So that's essentially, intermediaries are removed in as many places as possible. And let's look at what are the different initiatives happening. It's actually not day one when these initiatives are started happening. There is, what's the name? The, there were a few. There were a few initiatives with traditional finance.
Some consortiums. Yeah, yeah. There've been a few
Right.
that have come and
few
gone.
few
It is hard to
blockchains.
remember them all.
Oh, like Corda and
Yes, right, right.
and
A few large banks were in that one. Yeah.
right.
Hyperledge maybe was that
And
also a consortium?
Hyperledger, yeah. So Corda
Right.
probably didn't quite live till today, but Hyperledger kind of did. And this is one of the consortium things, which, by the way, also support EVM, which is very smart because you can just take EVM smart contracts from
They looked
real.
well set up. So, and well, not a consortium, but Ripple and XRP were supposed to take over. I used to follow them because the use case looked very solid. You mentioned the problems, the cost, the speed, and it looked like a reasonable solution.
Yeah,
But
and
still hasn't.
well, I'm
We mentioned on the show how some of these have taken so
well. There is
long.
also
I've given up.
Stellar, right? Uh,
Well, there's a few,
yeah,
I've
but also
how we've kind of given up hope that
right.
these would
But
actually
these
come
are
through.
kind of full blockchains, and also this new initiative you mentioned. It's based on blockchain made by Paradigm, I think, right?
Mm.
And it's an EVM blockchain. They tried to make it fast, but it's not necessarily super decentralized. It's really sort of controlled, right? I mean, it's running by consortium, but it's not really fully
Yeah, I
disintermediated,
don't.
right?
They want the benefits without the
Yeah.
autonomy portion,
So,
right?
so they still have intermediaries there, and I think there is another thing called Canton, which is sort of different because it doesn't really work like a blockchain which can run your financial service end to end. It's more like something to facilitate agreements or something. So it's
So why do you think these haven't taken off? Any of
mm,
these, or
yeah.
Ripple, which is trying so
Yeah,
hard
why
to.
these didn't take off? Because by the nature of how these organizations work, they definitely need compliance. So this part is
Mm.
that part is there, right? And they still want control over this thing. So they are not removing intermediaries. So we have intermediaries are still there and compliance is still there. And these two components are determine the costs. So if they replace it, they can do it, but the costs don't go away. The only thing they might do is they will replace a very obsolete infrastructure, like, I don't know, based on DB2 and COBOL, with some very modern blockchain
I was
solution.
about to mention COBOL. Yes, yeah.
Yeah, so instead of COBOL, we would have, I don't know, Solidity, right? Probably nice, actually. You have a lot of talent supporting it, and you can actually copy some code from the outside, which is also very nice. But other than that, yeah, the biggest cost drivers are still there. So you update things, but costs are still not solved. So was it worth it?
So you're putting together a lot of different pieces with a yield basis and the
Hmm.
staking and earning portion, which is kind of independent from Curve Finance, which has
Yeah.
swaps and
Oh, it's
stablecoin.
actually very
How are these?
connected.
Yeah, how are these going to work together? What's the overall vision?
Yeah,
And
yeah.
what are you still building to put it together?
Right. So, yeah, yield basis. How yield basis works? Um, it's actually making liquidity between cryptos and stablecoins, while eliminating a long-standing problem, impermanent loss. So for the user, it really looks like yield-bearing crypto, like yield-bearing Bitcoin, essentially. But what's under the hood? Under the hood, there is a liquidity between Bitcoin and US dollar, US dollar being Curve stablecoin, by the way. And this liquidity is leveraged by a factor of 2. So if you keep this leverage, like you keep the ratio between liquidity and debt constant, factor of 2, then apparently impermanent loss disappears. Like the pricing on the overall position will be like Bitcoin, but yield bearing. And that actually works pretty well. It was proven experimentally, not just theoretically, so it's very nice. But apparently, the liquidity, it has to have concentrated liquidity, which is automatically managed, which is what curve pools do. And for that, we use exactly the same type of pool as you can be used for foreign exchange. So we take foreign exchange pool, put Bitcoin and US dollar in it, leverage it by a factor of 2, and we use Curve stablecoin for that. And that actually pushes Curve stablecoin forward, because we are, with yield basis, we are kind of supporting Curve stablecoin supply sinks. And at the same time, trading volumes in Curve stablecoin are going up. But at the same time, we are also using Curve FX pools, which are actually very suitable for FX use case, for exchanging like US dollars to euros, for example. And that's another angle to it, which doesn't touch yield basis, but it's the same code which is powering it. So it's so that's interesting.
This all ties to a question that I had, which is that I believe you do something called soft liquidation, which is different from the way that I've seen other stablecoins work as well, in terms of the collateral, etc. Can you
Right.
explain what it is that
Absolutely.
what is soft liquidation, and
Yep.
how this is a core part of your business?
Right. Yeah. I don't know if it's good to say it like a soft liquidation or reversible liquidation, or
Sure.
but yeah. So this is what happens there. There is a type of stable coins called CDPs, collateral debt positions. What are these? These are all collateralized by crypto, right? And you have the value of crypto bigger than the value of stablecoin minted against it. So somebody borrows stablecoin against crypto and, I don't know, sells or something, buys groceries for it, or leverages using it, doesn't matter. So borrows stablecoin, mints stablecoin against crypto. But crypto goes up and down. So let's say you borrowed against Bitcoin, and Bitcoin starts going down, and you have this level of I don't know, value of debt. So when Bitcoin comes too close to the level of debt, what happens in like traditional CDP platform? Well, you have liquidation. So you have either all these Bitcoin sold and debt kind of repaid, or you can have it even partially. So you have this part of debt repaid, then this, and that's kind of pretty common. What happens in Curve is interesting. When collateral price goes down and it reaches the critical threshold, the Bitcoin, or whatever it is, Ethereum in collateral, starts getting converted to Curve stablecoin, to this. So you have your loan started being increasingly supported by stablecoin reserves. If price goes too low, like even to here, then you will have all your loan supported by essentially reserve, which is all converted to stablecoins. And now what happens if price of collateral starts going up from there? Well, it starts converting back. And basically, if you have a dip of Bitcoin price and then goes up again, well, it converts to stablecoins and then back to Bitcoin, and then you have your Bitcoin back, and you didn't lose it in the dip. So you didn't have liquidation right in your holdings during the dip. You actually have it all converted back. Well, there are some gotchas here. When you are in this conversion zone, then you have faster losses. So you have to look after half of your position, right? You may have to compensate some of these losses, and they can be, well, they are usually not very large. but you still have to watch it, because if you don't, then you do have the liquidation you wanted to avoid. So you have to watch it in a sense, and maybe sometimes repay 1 or 2% or whatever. But you can survive the dip, and that's kind of a unique part about it. Right?
Risk mitigation.
Yeah,
Yeah.
So
yeah.
how scalable is this? Let's say you get so many users from being on this podcast, on the Fintech Newscast,
Mm,
and you have hundreds of thousands, millions of people jumping in. Does the system slow down, or is it
mm.
what can you handle?
Oh, you mean with the soft liquidation?
The entire protocol, like if what volumes can it
Hmm.
handle?
Probably volumes as, I don't know, as big as the world demand for Bitcoin supports, right?
Because we've
And
seen like Ethereum or Bitcoin slow down and get very expensive.
We have seen
Uh,
this. Yeah.
ah, oh, that.
so
No,
does
that's
that start to happen with this system?
no. That's not. This system is not about quantity of transactions. It's actually any curve pools usually barely showed up in the charts of gas eaters, right? So they are usually fairly gas efficient, and well, unlike typical liquidations, you don't have to the system to run after like every user and liquidate every user. It just liquidates the range of prices. So it converts the range of prices and converts back the range of prices. And it's not iterating through the users. This is actually much cheaper in terms of gas. So it does scale in that sense. I think the real limits, at least of soft liquidation, where you can get, is that this conversion of Bitcoin to US dollars is selling, and conversion of US dollars to Bitcoin is buying. So will the market support this amount of selling or this amount of buying? Of course, for Bitcoin, probably the answer is yes, but you may get some exotic, rare collateral. And that one probably wouldn't necessarily work out if you have too much of it. So you have scalability limits really based on how much is
The
the
underlying
immediate demand for that in the market. There is another thing. This mechanism of soft liquidation, it assumes that prices are going smoothly, right? So if you have prices changing too drastically, then you can have immediate losses, right? And for Bitcoin, they're not changing too drastically, to be honest. They are slow to change. And for Ethereum as well, actually, right? So you may see like Ethereum dropped 10% this day or 20%, but it doesn't drop instantly. It actually happens over the day, right? With stocks, you actually can have these changes. I've seen stocks changing by a factor of 2 instantly, like in a second. This type of behavior is probably not great for this mechanism. The same applies to yield basis, by the way. It likes assets which are smooth to change prices. And if they are not smooth, if they're too jumpy, like stocks or like meme coins, then maybe it's not a good fit to put them there.
Hey,
So
it's interesting that you mentioned the yield basis. I'm curious. What are the problems that yield basis is solving now that sort of the current fixed yield DeFi protocols don't solve or miss?
yeah, well, I mean, what's the source of yield in fixed yield DeFi protocols? The source of yield is normally lending, right? And well, did you check how much you can earn on Bitcoin on Avi if you lend out Bitcoin to Avi, right? Well, it's like 0.3%, very, very low, because nobody wants to borrow Bitcoin really, right?
No.
But here, the source of yield is not lending. The source of yield is market making. So you actually earn from volatility. and reserves sitting out there in volatility, like reserves of profit potentially, are much bigger. Well, I mean, it's not maybe much bigger for Bitcoin, right? For USD, maybe maybe comparable, right? But yeah, it's not the only source of yield which is not lending. For example, Ethena tried to construct a source of yield which is not lending, right? So they did it for well, for US dollar, right? So, but they used asymmetry of the market. So they shorted Ethereum and staked Ethereum at the same time to make a delta neutral position, which is also making money. They scaled it all the way up to like to whatever it scaled to, like I don't know, 10 billions or something. And then market become more bearish, so that strategy stopped paying, and they converted pretty professionally, I must say, all this position to essentially treasury bills. So all this strategy is not really making money for them right now because market is in the bearish phase. So they converted it all to T-bills, waiting for the new good time. Yield basis apparently, well, it's a single strategy thing, right? But yield basis produces yield even now, right? So depend. So it really it really does work in different phases of the market. All you need is volatility, and volatility is here. So well, I mean, maybe not always it's a great volatility, but well, right now I wouldn't have expected big volatility, but we have all sorts of global news going on, like I don't know. Iran opening or closing like a Strait of Hormuz, or tariffs on tariffs off, all sorts of stuff. This does volatility in any sort of direction, and this is actually great.
And the idea
So,
is that curve and yield basis will be completely decentralized. I guess in other markets like Bitcoin, Ethereum, there can be a few whales that really control things,
Yeah.
and they can maybe manipulate the way they want the price with sales and things like that.
price
Uh,
they of course
is
can.
there still a chance that someone can just centralize control
Yeah,
of this,
so that's
just like
a
they do with
very
the rest of the
that's a very
economy
good point. I've
anyway?
been I've been thinking about that a lot before
Mm.
starting Curve, and how Curve and yield basis is built in terms of governance is really stemming from those thoughts. I thought exactly this way, that maybe if we have one token, one vote, it's not good because some whale can accumulate voting power and, I don't know, vote for something bad and, essentially destroy the protocol. So the way I solved it for Curve and later for yield basis, I invented something called VE tokenomics, voting escrow tokenomics. So your vote is not tokens; it's tokens multiplied by time. So you lock your tokens, and you say, I'm locking these tokens for at least, let's say, 4 years, right? So then my voting power is number of tokens multiplied by 4 years. All right, full voting power. And my voting power is 200 times larger than someone who locked the same number of tokens for just 1 week. Because I'm committed for a long time, and I probably would think twice before voting for anything stupid. Because if I vote for something stupid, then my investment would go to zero. Or maybe it will stop producing revenues, because when you lock your coins, you also get revenues only for the locked part. So if I do something which hurts the revenues, then my revenues go down. So and I cannot get out of this, right? So if I locked the tokens, I cannot really unlock them early, right? So I have to have them locked for a long time. So that's why I'm vested into the system with my
Is there any way
decisions.
to around this? Any way to manipulate, or you're in for the long term, so maybe you don't care about volatility in the short term? Have you seen anything that you're
Um,
like, oh, we need to correct for this behavior or potential manipulation or something like that?
yeah, I mean, prices can be manipulated for sure, but
Mm.
governance power cannot really be manipulated with those manipulations. That's what I've seen.
Yeah, so that's been working.
Yeah, that's been working. That proved to be working. And more surprisingly, we measured, we did some research. We measured how much um, CRV would be taken away from the market if instead of locking, we took all revenues which are going to the eCRV holders and bought CRV on the free market and burned, right?
Mm.
So are we taking away more CRV or less CRV from the market than buy and burn mechanism?
Mm.
And it appeared that we are, with locking, we are 3 times more effective than buy and burn. So we are removing 3 times more CRV from the market than buy and burn.
So if people are voting, like you mentioned, some protocol that you don't agree with, that you think will damage or cause some problem or get away from the intention of a curve or yield, could you still overwrite that? Is it at the point where it's beyond Michael Egorov,
I
or
cannot. Like, I
you don't
cannot.
have enough of the
I
vote?
don't have enough voting power. I did try, honestly, to push some decisions which I would like to see with other voters. So I really I don't know, got in the room, virtual room, with different sorts of voters who have large voting power or voting groups and tried to advocate for like certain votes. It's really hard. It's politics, seriously. I have to campaign. I have to prove my point. If I don't, I fail. I did fail several times doing that, honestly. And you just cannot. It's you really need to get everyone to consensus, otherwise they will not vote. Sometimes a vote is obvious, sometimes they all vote. They all respect me, but sometimes they don't want to
People
agree.
people tend to have their own ideas.
Yeah.
Yes. And but the thing is that they are all aligned with the future of protocol. They are caring about that. They may have different ideas what is good for the protocol, but they all want good to the protocol, and that's why they are arguing. And
Passionate.
that's
Yeah.
yeah. So and this is how it should be, I guess, right? But honestly, sometimes I was really annoyed and wanted to leave. But what stopped me is that I have a bunch of CRV locked, and invested in the system, and I don't have any way out of that. So I have to work with them, and then I work with them, and then it's good, apparently. So I'm glad that it happens this way. I cannot really rage quit, unfortunately, or fortunately, right?
Yeah.
So that's how it works.
Just yell at the mirror, Michael. Just yell at the mirror. Yeah, just
Have nothing
let it
else
out.
to
Let it
do,
out.
right? This is the beast I created. Now I have to live with it.
So do you think
Yeah.
this would work for, I'm curious, I haven't thought this through, but would this work for other types of organizations? I guess
I think it could.
blockchain based,
Oh,
it
I
seems to
think
make sense, but
it could work for non-blockchain organizations. But what's good about blockchain based is that you are fully trustless. You don't trust any intermediary to facilitate that. So nothing in the world can change how it works. It's immutable. It's not upgradable. Not
Hmm.
even vote of people in the system can change that.
But what is your view of where curve finance would be in 5 years in a best case scenario that you'd like to
Mm,
see? What's happening? What's the world of finance like?
yeah, that's a good question, because what's happening in finance um, looks like finance started started going into blockchain, or blockchain started absorbing the finance, but it started happening in different ways simultaneously. One way is what these consortiums are about, like top-down way. So what if big TradFi firms thought, what if we upgrade our infrastructure? Maybe we will reduce our costs by that. Maybe it's something else. So why don't we upgrade ourselves with all this goodness? And they try it from time to time. But there is also bottom-up approach. There is, well, a decentralized finance built up. And of course, there are crypto natives, but probably it's a minority, right? Relatively. And there are fintechs who are connected to the blockchain, and they are using all the blockchain goodness for their efficiency, because it's public infrastructure. It's up there. Why not use it? So they do. And these fintechs, they started growing. They are small at the moment, but they are growing. I don't know. I feel there is something happening there, right?
Hmm.
So what I
That's
think,
what we're all about, Michael.
yeah. So what I think, maybe this bottom-up movement can actually grow pretty big, and
Hmm.
really the time when it was DeFi summer in 2020, it was more about crypto natives. Crypto natives experimented um, uh, with uh, with finance on chain, with decentralized finance, all sorts of experiments. And what's happening right now, we have a bunch of small companies connected to real world, connecting with the chain to improve their efficiency with that infrastructure, which rooted
Hmm.
back in DeFi summer days. And it started helping them to be efficient. And then they started growing and growing the decentralized infrastructure together with them. All right. So that's, I think, what is happening. So if that continues happening, I don't know in how many years, but we will have what, maybe maybe foreign exchange will start moving on chain. Well, it's a little bit laughable today, because such a small fraction of foreign exchange is happening on chain. It's really tiny. It's like 99% of stable coins are US dollars, and we are talking about US dollars converted to euros, to Swiss francs, to, I don't know, something else,
Whatever.
Turkish
Yeah.
liras, and Chinese yuans, and whatever. We are so far from that. But this, it didn't happen a few years ago, but it started happening right now. And
Hmm.
while it's very small, it really attracts my attention. And I am wondering if this can, actually get as big as the normal finance at some point, right? And
Find out, Michael. Find out.
yeah, but I do want Curve to
So
be in the center of it.
yeah. So what is it you're working on now? What's the next few things that you have to build to grow this, to
Yeah,
get to where
well,
you want?
right. Well, I mean, you mentioned yield basis. I want to scale that. It's a very, I would say, scientific thing, and you have two things: how to, uh, how to earn as big APRs as possible there safely, and how to scale it,
Hmm.
right? So both are not very easy problems. I'm working on that. On Curve, we have lending protocol with soft liquidation, which you mentioned. Um, we want to grow that. We want to merge that with exchange of stablecoins, which Curve also is. to essentially scale them together. And foreign exchange use case looks very, very interesting. It's small at the moment, but very, very interesting. So I kind of have to work on in all these areas.
Yeah, well, that's a lot already. I saw you have the swaps on there, which is very important for risk mitigation and doing foreign exchange transactions. Are you thinking of other kinds of derivatives to add down the line
Maybe
to
we'll
make it
see.
easier for risk management purposes?
Another thing which is kind of hot is RWAs, right? Real world assets, and how
I like
they.
how real world assets has its own acronym now. There
Yeah,
used to
like
be,
what is even that, right?
yeah, what is, yeah, yeah.
Well, we see tokenized stocks appearing, right? Or tokenized indices. So, like
Yeah.
Ethena, I mentioned, has a very, very exciting strategy, but that strategy doesn't work in these market conditions. So they backed off to T-bills. So, it's good to have tokenized T-bills for that. Why not?
So is it frustrating when you see things like rug pulls and meme coins?
Yeah, it is
And just
frustrating.
yeah, lowering
Shit
trust.
coins. Yeah.
Melania coin.
Absolutely,
Yeah.
absolutely. But in 2014, we've got Mt. Gox collapse. It was
Yeah.
extremely frustrating. Everyone thought Bitcoin is dead.
12 years already. Wow.
In 2017, we had a bunch of ICOs. A lot of them were vaporware. Some of them were outright scam. And well, there was also OneCoin and like scams similar to that. So pretty bad taste, to be honest. And well, Ethereum got a big hit after that stuff collapsing, of course. In 2021, well, 2022, we've got Terra collapsing, right? With some, I don't know, some pretty suspicious circumstances, I must say.
Where are those dollars today? Yeah.
Right. And we had FTX collapsing. And I mean, arguably SBF made some extremely good investments. And maybe if it didn't collapse, this whole thing would have been very successful. But nevertheless, he did, he did use customer money without their knowledge, and this collapse was real. So
A lot of people
everyone,
in prison often say, if I hadn't been a criminal, I would have been very successful.
yeah,
So
well,
that's a big counterfactual.
anyhow, it was a bad aftertaste after that. Everything looked totally doomed. Question is, are meme coins, which actually really exist since forever, are meme coins worse than that? I'm not sure. I mean, I don't like meme coins. I never touch them. I think they're a scam, but they are less of a scam than a bunch of stuff which already was happening. Let's say that.
Okay. So a shorter jail sentence. Not quite as
Um,
long.
I don't
Well,
know.
it's
Yeah.
nice to see that you're building something with, just solid thought through governance, something that's looking to solve real problems. Yield basis looks like I'm trying to think of issues or problems with that, but we'll see as you scale. We certainly hope you do.
Yeah.
And we wish you all the luck on continuing and seeing that your governance holds up to every possible
Yeah.
thing that people think of.
Interesting thing is that scaling yield basis would have to be scaling curve stablecoin, and scaling curve stablecoin would scale a bunch of other things like liquidity, stablecoin liquidity on curves. So it's all going together.
It's a
And
flywheel.
yeah, quite a bit of stuff to work on.
And it looks like it would be good for everyone. So thank you so much for joining us and helping us understand a little bit on the latest ideas. Thanks so much for joining.
Yeah, thank you. Very interesting conversation.
From you for sure. Yeah, thank you so much. That's Michael Egorov, the founder of Curve Finance and Yield Basis. Please subscribe to keep up with the latest in fintech news. And thank you for listening.